Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
G'day, welcome to the Australian Property Podcast. This is our weekly 2 cents segment. I'm Pete Wargent. I'm joined, as usual, by Chris Bates. Batesy, how's your week been?
Life's been good here, Pete. Not too much to report on, really. It's just dad life and the normal family life and lots going on at work, which is great. It's a very busy time of the year for us. This sort of spring sort of time where there's usually a bit more properties on the market and people are keen to transact, but it's probably already middle of October now, right? So it's crazy. It's maybe another month of good listings coming on at best. And so, yeah, hopefully another good month of activity out there. It's definitely an increased urgency out there. We've had multiple clients buy over sort of 2-3 million. One yesterday, circa 4 million, which we haven't really seen for some time. It's definitely the confidence is increasing at the high end, not just at the lower end.
Yeah, it's interesting you say that. We've actually had, just in the past week or two, we've probably had 3 or 4 properties go under contract in Brisbane. I think, yeah, we've been finding it hard, but actually, I think you're right. There's a bit of a sense of urgency because before we even know it, we'll be coming around to November, and then people's minds start turning towards the Christmas holiday period, and listings drop away. And definitely in Queensland, a lot of people actually go away for Christmas and New Year, and nothing really happens until Australia Day weekend, certainly from an auction perspective. So, yeah, but it's good to see we're actually getting some stuff bought down in Brisbane. I'm just up in Cairns today. It's my daughter's 9th birthday, so we've just been out on the reef this week. First time the kids have done that. So, interesting to see Cairns absolutely bustling away as well. A lot of tourism. Everything's full and everything's expensive. So, yeah, it's, I guess, mirroring what's happening in other parts of the country. So, yeah, it's a lot happening. But, yeah, before we know it, we'll be talking about what happens in the lead up to Christmas. So the year's gone quickly.
Yeah, absolutely. And I think just reflecting on a couple of purchases this week, it's, both of those have been looking for, at least 6 months, maybe closer to 12 months, I would say, since the start of this year. And, they've just been very patient and persistent, just very much. And they've been blown out a few times at auctions where they've been, falling for the underquoting. But they've both got great assets. One's like a massive north-facing rear in the inner north, really good asset. And the other one got a really good terrace in the in the city. It was, but they were very, close to buying a few poor assets along that journey as well, where there was just very little quality stock on the market. And so not only are they buying, but they're actually starting to get better quality assets, which is great because there's a bit more on the market. So what's the 3 we're going to talk about this week, Pete? What's the stories?
So 3 stories. Firstly, ABC News did a piece on the increasing use of granny flats, desperate Aussies turning to granny flats due to the rental shortage. Second story, property investors are driving the mortgage rebound. That was an ABS release, a statistical release, also covered by Macro Business. And actually, yes, a couple of our purchases this week have been investor clients. So it's not quite as simple as investors leaving the market. There's a lot of churn going on, and quite a lot of investors are actually coming back into the market now and lending, getting close to its 2015 peak for investors, partly due to higher prices. And thirdly, 1 in 3 large builders losing money. So this was a big news story the Reserve Bank put out as part of its financial stability review. Maybe not that big of a surprise, I guess. We've seen a lot of insolvencies in the sector, but just to see, even at the big end of town, so many builders burning negative cash flow, quite a shock, really. And yeah, some interesting comments there in the Fin Review as well in one of their pieces. So let's start with the granny flats story, Chris. So ABC did quite a long form piece here and citing some very specific examples, essentially talking about an ongoing rental crisis and rising property prices, which is pushing more people across more demographics into share housing and house sitting and secondary dwelling. So I guess the name granny flat, we traditionally think of the next generation up, just a space for somebody, effectively grandparents, to live with the extended family out the back. But increasingly, it seems granny flats are being used across all kinds of different age cohorts, younger people. Certainly in Noosa, almost every single day, there's people asking, looking for a room to rent or a room to share. Now, if you went back not so long ago, people could find rentals by themselves, but now individual granny flats or rooms are renting for a few $100s a week. So certainly seen it on the Sunshine Coast. And a number of the companies that provide these granny flats are saying they've just seen soaring inquiries over the past couple of years. So I guess this speaks to just generally the undersupply of dwellings that we're seeing across the country, rapid immigration that's come back online, and rents are rising pretty quickly.
Yeah, I mean, the poor granny, right? We don't see granddad flats, do we? Why do the grannies always get the flats, I guess? But I mean, the whole sort of idea behind it, it's a pretty sound one for supporting the rental crisis, right? And supporting people with under mortgage stress. So if they've got maybe, 100 or 150 left over in equity, maybe they could use that to build a granny flat but it has to be a bigger block. You can't do this on a 300 or 400 blocks. It usually has to be in the more middle and outer rings where people have got access to bigger blocks. But any people who've got bigger blocks around the city, they generally don't want to turn their land into a second dwelling. They'll usually try to keep it for a pool or a backyard, and that will increase its value more than a second dwelling, right? So I think ultimately, it's a good thing, if we can create, but it means we're going to get denser suburbs. It's going to put more pressure on our water, our electricity. And but I also think councils are going to allow this a lot easier. I mean, Victorian government sort of came out and changed some planning controls around second dwellings. And I think it's great for councils, particularly if they can start to charge more rates and things like that, if they can able to do that. So I think but I just got to be careful. If you're an investor and you're putting a granny flat on your property, you might actually make that much sense to you, right? Firstly, you've got to build it, so you've got to pay for it. Yes, you get some rental income on it, but then you've got to pay interest on the cost of the granny flat. And you've got to, and maybe you're not going to add a dollar for dollar, right? So you might spend 150 on a granny flat, might cost you 10 grand a year in interest, right? But you might only get $300 a week rent. So $300 a week rent seems like a lot of money. That's 15 grand a year. Once you minus off your 10K interest, and then you minus off actual depreciation, what's actually costing you, it's falling in value. How much are you really making on this thing? A couple of grand a year, maybe. And you're potentially having to maybe reduce the rent on the front property as well, because that person renting it had a big backyard. Now they haven't got a backyard, right? So they only want to pay $600, not $700 a week, right? So you've got to be really careful. The second thing is, because it sounds great on paper, but really how much money is it making you? Under low interest rates, under low build costs, maybe it's better bang for buck. The other thing is, if you're an investor and you try to sell it, if you've got it trying to sell it as two dwellings on one property, that may rule you out of the owner-occupier market, or someone who wants to build their dream home, or because they're going to look at it and go, I'm going to knock down two places, not one. And so you really try to target the investor market. Now, if the investor market is really active in that area, then great. Maybe if having two dwellings is going to get you a better price. But if it's owner-occupier driven, and particularly sort of higher income owner-occupier driven, they don't really want the granny flat. They don't really want someone sharing their space. They'd actually prefer that just to be flat land, and they could put, a garden, a cubby house, and a pool on there for the kids, rather than a second dwelling at the back. Now, sometimes I've seen it work when people have got a garage out the back and they've got a second dwelling on top of the garage, so it doesn't really lose any space. And it can be done in a way that still means that they've still got great privacy, and they don't really even notice the other person living there. Okay, that could work. There's also issues with tax. So, if it's an owner-occupier, we just did an episode with George Maurice on this podcast. You should probably have a listen to that one. And there's issues around renting out a room or even a granny flat on your property if it's your owner-occupier place of residence. So, yeah, I think granny flats are seen as the holy grail. You get a great asset, great capital growth, but also great income. That's true if you're an investor and you hold it long term. You're better having two rental incomes than one over the longer term. But ultimately, it may not increase your capital growth because you've already got the land anyway.
This was a debate that we had quite a lot about 8 to 9 years ago in Brisbane with the new city plan. There was low, medium density zoned blocks. And if you had a, say, a 600 square meter block with a house on it, should you put a couple of townhouses on the back? Yes, I guess if you're looking for the rental income, but you do have to think the house has now got, instead of having a back garden or a pool, has now got a couple of extra dwellings at the back. And have you decreased the value of the main dwelling? You know, there's lots of, it's not quite as clear cut as more rent is more value. Sometimes you might be creating extra headaches or devaluing the property at the front of the block, or so there's plenty there to consider and a bit more nuance. So CoreLogic said the rental shortage is actually getting worse. Number of rentals available is now at a record low, with just 1.1% of available properties sitting vacant in September. Much tighter still, I guess, in Perth, in Brisbane, increasingly in Melbourne, it seems. Sydney's very tight. Perth is extremely tight. Adelaide's very tight. So a lot of the capital cities just seeing very, very tight rental markets. The median weekly rent has increased by more than 30% over the past 3 years, or about $140 a week since July 2020. So CoreLogic's Eliza Owen said big factor here was that desire for people to get bigger homes with fewer people through the pandemic. Because if you went back 3 or 4 decades ago, we had about, on average, 3 people per dwelling, and it's fallen to nearly 2. So even with the same number of people, we need more housing. But obviously, we've got now record high population growth as well. So Eliza Owen said there's been a shortfall in investors building new properties for renters as interest rates have increased. And a couple of the granny flat companies, so Granny Flats in Cabins Victoria, said they've been building a lot more for kids coming back and in-laws. So it's not just about grannies, and that's due to rents going up. Also, another granny flat company, DIY Granny Flat, said they've seen over the past 18 months, inquiries have doubled. So, look, there's a lot of pressure on the rental market, Chris. And as I think we've touched on before, right down at the bottom end of the rental market, people are really grappling with the market conditions and just struggling to find somewhere to rent even.
Yeah, and I think that, if more granny flats get built, that's going to potentially, building a high-rise apartments, which we've spoken about, building lots of townhouse development. These things take years. Granny flats don't usually take as long, and particularly if you can get through council really easy. And so I think this is a way of increasing our dwellings, I guess our rooms that are available for rent, and that's a good thing. Even if it's taking people out of, helping your family, well, you're potentially stopping them having to rent something else. So I'm all for this. But as an investor or a property owner, I'd just be a little bit hesitant doing it to my own properties. Some properties, absolutely, we've seen it work. I can think of a client up in Central Coast where they had a corner block. They could potentially, they cut off the back of the property, and it didn't really impact the front property. They lost a little bit of land, but they still had enough land on that property to be super desirable to a high-income family. And then they had this second dwelling at the back that had a separate entrance, and it was done really well. But I've been to lots of properties, where, you share a driveway, or the backyard is so small in the front property that it's not even that, you can't even use the backyard. So you've got 2 dwellings, but it's just, you butchered the first property, and you've really decreased the value of that property to get an extra income. And I just don't think you'd sell it for anywhere near as much as what it just cost to build the granny flat, because you basically ruled out the owner-occupier market. So be really hesitant doing. And as an investor that goes and buys property that have 2 incomes, just be aware that, that's 2 people you've got to get rent off. It's not just that, 2 tenants you need to manage, and that when you ever sell it one day, you're going to be at the mercy of the investor market, because if it's not suited to the owner-occupier market, if that owner-occupier market is driving the market, which that is the predominant force in the market, you just got to hope that when you sell it one day, that the investors are really active in that area. So just be really careful.
Yeah, think about the resale and who you're going to be selling to. Just to wrap up on this one, CoreLogic economist Eliza Owen doesn't have good news for renters in the short term. There's going to be some pain as we continue to see strong flows of net overseas migration. She says that's from the ABC News piece. That said, CoreLogic is not showing the price of asking rents soaring as quickly now, partly due to affordability. And Ms. Owen also believes investors may get back into building new rentals in the coming years, as economists predicts that interest rates will ease off for lending. So yes, actually, just in the past few days, there's been a bit of a shift in market pricing, and markets starting to think about interest rate cuts towards the end of 2024, which I think would be something that would drive an investor rebound and maybe get construction happening again. But I saw a piece by Roger Montgomery this week, the fund manager. He said you can forget all economist forecasts. Construction is not going to lift until prices rise significantly, which is attuned with my understanding of how property markets work. We've seen this in previous cycles. If interest rates are high and prices aren't high enough, nobody's going to be building. But if prices start to rise, that could drive confidence. Chris, this kind of maps into the second story, property investors beginning to drive a mortgage rebound. So the lending figures from the ABS rose 2.2% in August. Investor commitments rose 1.6%. Owner-occupier commitments up 2.6%. But actually over the year, mortgage commitments are now only about 9% lower, and investor mortgage commitments are only 3% lower. So they're getting back now towards the 2015 peak. This was quite interesting because a lot of the news stories are talking about investors leaving the market, but clearly there's a bit of churn here because more investors are coming into the market as well, maybe just as a result of growing confidence. Is that something you've seen as a broker?
Yeah, so there is a cohort of people that have usually, or first-home buyers that can't afford to buy, so they're buying investment properties. So they'll go down. It's really a first-home buyer, but they're forced to buy an investment property. I think that's leading to higher figures. So the loan will be investment debt, not owner-occupied debt. They'd love to buy a home, but they're being forced to buy an investment just because of capacity. And so I think that's probably looking at the figures. So I don't think that's really investor debt, to be honest. I think it's, invested in my mind a lot of the time is when someone's got a home or maybe they're rent vesting and they've got multiple investment properties and they're just seeing themselves as investors. And so I think a lot of those multiple property investors are capped out. They have got, because they've leveraged up, they've used their capacity and they can't have any more capacity unless their incomes have gone up 40% and then a lot more than that to increase the capacity. So I'd say that first time property investor is there, but a lot of them still have capacity problems. I had a client yesterday, they want to buy an investment property, but they can only borrow 400. So, last year ago, they could have bought 900 on top of their current debt. So, their options are completely different. So in their situation, they're just going to keep that gunpowder back. So I do think that's there, but I don't think every homeowner's got the ability to, borrow a lot of money. And if they can't borrow a lot of money, then a lot of them are deciding not to use it. However, there's a lot of spruiking going on right now in the investment property space, probably more than I've ever seen it, to be honest, on the multiple different channels, whether it's YouTube or whether it's on the other social channels. And they're all pushing this, low data-driven, cheap investment properties on high yields. And, they're looking at places like Perth, etc. And so I think there's that. There's a lot of people who they're falling for the marketing of this holy grail, amazing yield and amazing capital growth and no risk and just get in. And what you're doing is you're seeing investor gluts going to areas where and you're flipping markets from usually owner-occupier driven to investor driven. And what that does is create more rental supply in those areas, and it completely changes the dynamic of those areas, and they become less desirable to owner-occupiers. So I would say there's that. There's a lot of investors that are going for the cheaper stuff right now, particularly because the rates are higher and they want a higher yield to offset that. So yeah, but I do think that a lot of the higher income people, a lot of them have got capacity problems and they've got other mortgage they need to service on high interest rates and they don't want to leverage up.
That's an interesting point. I guess as somebody who's been self-employed for at least the last dozen years and longer, there's been various times where my borrowing capacity has been quite constrained and you've only got so much to play with, and therefore you either have a choice. You either wait until your borrowing capacity is stronger or you just pull the trigger and use the borrowing capacity you've got to the best of your ability. And that sometimes pushes you into the cheaper markets. Now, my experience of that over the long run is you quite often can find some of the sort of counter-cyclical markets or the cheaper end of the market, you can get a really nice run on capital growth for 2 or 3 years. You might get 30 or 40% as an area takes off, but then you might find a very long period where nothing really happens. Maybe you get a decade of no performance. And I guess that can be the case sometimes if you're focusing on the cheapest available property or asset or those cheaper markets. You can get a nice little uplift as everyone piles in, but then you might find over the very long run it's not actually a stronger performing asset. So those are the things that people have to weigh up, especially with borrowing capacities quite constrained as they are at the moment. So just to circle back to the macro business analysis. Oh, sorry, you go,
on
Chris.
that point, Pete, you know, like if someone does use their 400 or 500 now, right, then it's gone. You know, it's gone until they sell, right? Because you've used your capacity. Yeah, that's the limited resource we've all got. So you need to be really careful and protect your borrowing capacity. I think it's a mindset shift. It's not something there to be used flippantly and I could always just get more borrowing capacity. No, we're always going to have a limit on how much capacity we've got. And more may come in the future. So you may say, well, I don't want to use that now because in 12 months' time, I might have more. So in 12 months' time, this client particular I'm talking about yesterday, I mean, she's on maternity leave. She'll go back full time. That's going to pump it up. He's got a business. He reckons this year financially is going much better than last year. So that's going to pump it up. You know, rate cuts potentially next year. APRA could step in next year. Tax cuts next year. Bank innovation, which is going to be inevitable, really. Under low borrowing capacity, banks are going to do anything they can to increase borrowing capacities. It's in their incentive. So, so they potentially go and use it now. They bet on an area, even if it goes up 20%. How much money do they make? Not much, because you might make 7% on whatever they buy it, so 30 grand. But if it goes up 30 or 40, which would be a really big call, big bet, over 2 or 3 years, you'd have to get it perfectly right. You'd have to basically, to get it go up 30 or 40, it's probably, you basically have to get in before it starts going up. Because if it's already started going up, it goes up fast. So it might have gone up 15, 20% already. Well, then it's got to go up 50 or 60%. Not many markets go up 50 or 60% in the short run, right? So you basically need to get to the party before anyone else gets there, right? And that's a risk, because you have to be counter-cyclical. You have to be the person who's betting when no one else is betting. And so to get 30, 40%, you've got to get there early, and then you've got to basically get out while there's still some FOMO in the market. And it's hard to get out, because usually what happens is the market will top, and then it'll quickly decline a bit when that FOMO takes out of the market, and then it'll stabilize. And so to get that true 30, 40, you've got to get in early and you've got to get out just before the top hits. And it's like climbing a mountain. I remember the old the Price is Right game. There was a young lady used to climb the mountain. You had to sort of push the button before he fell off the mountain. I think that's an analogy I think investors sometimes should think about.
Yes, look, we've talked about this a couple of times before. As somebody tries to be a counter-cyclical investor these days, there have been times when it's been possible. Geelong around 2014 was one, like when everyone was talking about the factory closures. In Brisbane in 2017, when everybody was crapping their pants about the massive overbuilding, there was a lot of forced sellers or very willing sellers, and you could buy stuff really cheap in the blue chip areas. But it's one thing to sit here and say, you know, this is the way to do it. It's actually much harder in real time when the headlines are telling you it's the end of the world and it's a financial stability risk and the market's going to crash. It's quite hard to be the person who says, right, now's my opportunity. And it's exactly the same in the stock market, by the way. When the markets are at the bottom, headlines are screaming about the end of the world. That's your opportunity, but it's much harder to actually buy than it sounds. So Macro Business said the two charts above in their article show that the mortgage rebound growth is overall being driven by investors, with the value of investor commitments almost back at the 2015 peak. Leith Van Onselen, a Macro Business. This flies in the face of recent reports claiming that investors are bailing out. With a higher than usual share of investors selling, there are also more investors purchasing. So there's plenty of churn in the market. Just one thing that stood out, Chris, in the ABS figures, though, lending to purchase and construct a new home over the past quarter is now the lowest in 15 years since 2008. So yes, investors are getting back, but they're not keen at all on buying new or constructing at the moment. So I guess that really partly explains why we do have such a significant shortage of dwellings, especially rentals.
Yeah, I mean, that's really concerning, isn't it? I mean, that's a real... Construction industry's had a really rough run. Weather, COVID, building prices, labour, you know, the whole home builder thing and the competition and buying work and, you know, the fixed price contracts and losses. And, you know, I do really feel for the construction industry. We're seeing massive insolvencies and they're already running on tight margins. A lot of people think the developers and builders run on big profit margins. They don't. They run on pretty tight margins. And, you know, their return on equity or return on cash can be really high, you know, because they're leveraging their money, but they're taking enormous risk to get that return on equity. The margin on the job isn't as high as people think, just because of the competitiveness in there. But maybe that competitiveness isn't going to be there as much because we've had all this insolvencies and businesses have gone under, and builders are going to want bigger margins to justify the risk. So I think that, it's not great. You know, when you're growing our population at your famous stat, Pete, 2,000 people a day, 500,000-700,000 a year, we need to be building more than we ever have. And this flies in the face of the $1.2 million homes they want to build in the next 5 years. Well, it's pretty optimistic when we're at the lowest since 2008. The investors entering the market, I think even if there is a number of volume of loans is similar to 2015, it's nowhere near like it was in 2020 or 2021, right? I think to offset the amount of people leaving, it's got to be way higher than where it is now. I think there's a lot of investors that are closing debt down on investment properties that is going to be way more than the 10, 15 billion a month or whatever it is of investor debt. It's not even that, circa 10 billion a month. I think there's a lot more debt leaving the system for investors than entering.
Well, in fact, you'd be right, because the Reserve Bank does show credit growth figures on a monthly basis, and yes, on a net basis. So the growth in credit to investors is very, very low. It's running at about 0.2% a month, so basically nothing. So there's a lot of people selling or paying down debt as well as entering the market. So third and final news story this week, a third of large builders are losing money. So the Reserve Bank, as part of its financial stability review, this quarter did an article on this. So despite talk of greedy developers, many of them are going bust. A third of larger developers are burning negative cash flow, according to the financial stability review. A couple of articles in the Fin Review covered this. 1 in 3 big home builders are losing money. Almost 1 in 3 large home builders are hemorrhaging cash, said the Fin Review, as the construction sector battles rapidly rising wages and materials costs, leading to a surge in insolvencies. Hutchinson Builders, the largest constructing contractor in Queensland, said even his company, this is the CEO, Scott speaking, said that in some months, even with a $3 billion annual revenue, some months the negative cash flow being reported. And he said, Scott Hutchinson told the AFR, that's an understatement for a lot of family-owned companies. It wouldn't be every month, but some months effectively just losing money. We saw a couple more insolvencies over the past week. Victoria, South Australia. We've seen another developer in New South Wales not finishing projects and leaving people out of pocket with their deposits. So as you were just touching on before there, Chris, a lot of pressure, thin margins. We've got leverage, rising interest rates, costs have soared for materials, and now it seems wages as well. There's a real shortage of skills across the construction sector, because construction has been booming in other parts of the market, things like mining, infrastructure. So it's not just a housing story. And yes, the government may have increased its target from 1 million homes in 5 years to 1.2 million. But anyone can change a target. The reality is we're just not doing it.
Yeah, I mean, I've got a huge construction client that I do, financial well-being. When I was a financial advisor, I used to set up their super fund and individual financial advice for all their staff. And I still act in a property mortgage capacity for the business. And so I'm constantly talking to their staff members at all levels, everything from the contract administrator to the project manager to the construction manager to the head of industrial to all elements of the business. And I always ask them, a good litmus test for me is what's happening on the ground when I'm talking to them, because they're pricing up jobs, they're competing, they're doing tenders for jobs, and you can see how competitive markets is. And buildings are all, I think, while homes and resis a big part of the market, so is schools, so is roads, so is major infrastructure projects like the trains that are going under our cities and the airport out in Western Sydney and everything that's happening in Brisbane for the Olympics. And so, there's a lot of pressure in this space. I think that's, a couple of bad jobs can really hurt you, right? It's because the margins are tight. If something really goes wrong, even if weather's causing that or something out of your control, your kitty gets evaporated, your buffer. We really need a real strong construction industry. I think this is where you're going to see some real support coming into the market, whether it's government and subsidies or whatever it might be to help back in 2020, 2021, I think the labour was a massive issue when I was talking to. Whether that's sort of still happening, whether people have got the confidence to switch construction companies in this market, I don't know. If I was on a good wicket, I was at a company that took care of me, would I just gamble and try to take another 15, 20% pay rise, knowing that company may or may not be around when it's when the grass is always greener? Do you do that in this market, or do you stay and not get a bit too overconfident on your income? I think back a couple of years ago, people were becoming project manager and then leaving a couple of months later and picking up a 50, 100K pay bump just to swap companies. And the construction industry is a tough job. It is deadlines. There's so much money and pressure on certain dates. And if it doesn't get done by certain dates, there's big penalties, and, there's settlements, and there's holding costs, and so when things start, when things are going well, I think everything's okay. But when things are running behind, it is a tough job. You are expected to work ridiculous hours. So,
it's a tough time. Yeah. So the RBA piece showed insolvencies went very low during 2020 and 21. We effectively had a moratorium on companies going insolvent. They've come absolutely roaring back, but construction in particular, now almost a third of insolvencies accounted for by the construction sector. I think just to finish on a slightly brighter note, Chris, on the day of recording, the Fin Review covered the Cordell Construction Index, and it showed over the September quarter, the pace of growth in construction cost eased by 0.2 of a percentage point to 0.5% over the September quarter. So cost is still going up, but that is the lowest rate of growth since 2015. So Tim Lawless said this is potentially signalling lower inflation figures ahead. Construction costs are now hardly rising, at least compared to what they were over the past year, increasing at a milder level now. So this is great news for inflation as housing, said Tim Lawless, as it's the biggest weighting in inflation measurement, and the cost of new residential owner-occupier homes is the biggest component of the housing category. There was also earlier this week the National Australia Bank Business Survey. I always like to read this, Chris, because I guess it's the nearest we have to a real-time indicator of what's happening in the economy. A lot of the ABS figures are kind of backward-looking and tell you what was happening a few months ago. But the NAB survey for the September quarter showed price pressures really tumbling. Labour costs, purchase costs, selling costs, across the board, really, a big drop. Now, we had record high inflation pressures in 2022, but now they're normalizing all the way back down. So I think this suggests anyway that interest rates are pretty much at the peak now, and the higher interest rates that have been delivered are doing what they were supposed to. Unemployment starting to rise. The cost of materials is easing off for builders. I think sales prices generally, at least according to the NAB survey, are starting to ease away. So I think there's been a lot of panic over the past 15 months about the trajectory of inflation and prices, but it seems that's ebbing away now, and the higher interest rates are doing their job.
Yeah, the Steve the Cook does his 2-minute update. So I listened to one he did yesterday on this, and he sort of made some good points. He said it's the final nail in the coffin for rate increases, right? Because he basically what you're talking about. And you mentioned Roger Montgomery before. And we had him on the Elephant years ago, and he does really get property, I feel. He does understand liquidity and scarcity and what drives prices and the lifestyle benefit of assets. And so his point there, where you were right, you've been saying the exact same thing, Pete, where, it's not until prices go up substantially that builders can make a profit enough to then they'll go and build. And the Victorian government brought out some issues with land banking, right? Trying to target developers that have got land that they could develop, and they're going to charge them, a vacancy tax on it. I think that's pretty hard to put more taxes on developers right now, because it's not their problem to want to develop that land when they can actually make a profit. They own it, right? It's hard to say you need to develop it right now if it's not profitable. Well, how can you force someone who's already, on tight margins to build something if it's not profitable? So, I think this is going to be a big story over 2024. This isn't going to go away, and so isn't our rental crisis, our housing affordability crisis. I think this are going to be a real YIMBY versus NIMBY is going to come out a lot, and it's going to be a big conversation in 2024.
I enjoyed the Roger Montgomery episode you guys did. I think sometimes it's good to get to understand the person behind the business. I think especially in funds management and to some degree in real estate commentary, there's some big egos and big opinions out there, but actually hearing his background story and how he came to be in financial services as a fund manager, it kind of changes your perspective a little bit. And certainly in alignment with what he's saying there is that if you're going to get more supply to come online, you can sort of governments can tweak around the margins, but actually the problem is that builders aren't making any money, and until prices go up, construction is just not going to lift. So pretty interesting point, and I wholeheartedly agree with his macro viewpoint there. So big three news stories this week: desperate Aussies turning to granny flats, long form piece from the ABC. Property investors drive the mortgage rebound. Australian Bureau of Statistics, and analysed by Macro Business, and a couple of pieces in the Fin Review, sort of resulting from the Reserve Bank's financial stability review. 1 in 3 large builders are now losing money, which really doesn't suggest we're going to be delivering 1.2 million homes over 5 years. Well, let alone if we can hit the 1 million target first, would be a good start. So that's it for today, I think. So thank you so much, Chris, and thanks everyone for tuning in. As usual, send us your property questions via the link in the show notes if you just want to say hello. You can catch me on Twitter at Pete Wargent. On my daily blog is Pete Wargent Blogspot. And Chris, if people want to give you a yarn over a Blusk, where should they go?
Definitely jump in the show notes and fill in the small type form, and we'll get in touch and book a call. You can actually book directly on that form as well. Sorry we didn't get the 2 cents out last Sunday. If you were sort of eagerly waiting, hopefully that tax episode was enough to satisfy you with George. The Rask team had a huge few weeks with the Rask Road show, so we got delayed a couple of days. But so it's not 2 cents this week; it's 4 cents. So we're adding up the dollars here, Pete. Hope everyone has enjoyed the listen today, and have a great Sunday.
Cheers. Thanks, Chris.